Hello everyone and welcome to our video on Ford Motor Company's pension plan. We're going to be discussing the lump sum discount rates and decision points. What's really good about this presentation is that yes, it's about Ford, we're drilling into their particular plan, but this is a video that's really good for a lot of pension plans that are out in the marketplace. So if you're a Ford employee, great. If you're not, there's still value to be had within this presentation. Just real quickly, wanted to kind of give you guys a background on who you're talking with today. So my name is Jeremy Whidden, and I am one of the partners here of OnTrack Wealth Management. Beside me is Jim Burns. He's our other partner, and he's our Chief Investment Officer. Jim, tell us a little bit about yourself.
Yeah, thank you. So my background is actually I started off in accounting, and so I am a certified public accountant. I found that life to not be fulfilling enough for me, and realized I was meant to work with people and be a planner. So I'm also a certified financial planner and one of the partners and investment advisors here at OnTrack.
Thanks, Jim. So the interesting story that I have is that I was actually a client of Jim's for many, many years. And I've had 20 years of experience as a client before I got into this business. Prior to this business, I was a vice president at a large oil company, did that for many years. But since then, have gotten into investment planning myself. I really, really love this line of work. One of the things that ties us together is that we are very, very interested in the client side of things, understanding who we're working with, getting to understand them, and really trying to build out plans that match up with their dreams. So that's a little bit. Here's a little bit about our firm. OnTrack Wealth Management is a unique RIA, or Registered Investment Advisor. We'll talk about that a little bit more in a moment. But our company actually, our name actually stands for several different things. In particular, we've got tax efficiencies. Tell us a little bit about tax efficiencies and OnTrack, Jim.
Yeah, so the tax efficiencies are critical to the long-term success of an individual's retirement plan. Taxes are, death and taxes is the joke of the only guarantees in life, and as people age, the cost of their tax bill becomes larger and larger. So effectively navigating that and being proactive from a tax plan perspective can often bring substantial tax efficiencies and savings to an individual.
And significant for the conversation today, taxes are a big part of pensions. So we will dive into that a little bit. Risk management is another area. That's the R in track. We really get to understand our clients' risk profiles so that we can match up and get them in the appropriate investments. A stands for aligned interest. We are a fee-only fiduciary. We will talk a little bit more about that as we go along in the presentation today. C is the cost-conscious section. Jim, talk to us a little bit about that.
Yeah, so the cost-conscious, again, costs matter, and the investment that are out there and available for the public at large come at varying costs. And one of the benefits of working with an RIA like OnTrack is that our clients' aggregate portfolios are used to create we'll call it economies of scale discounts that benefit all of our clients with lower cost investment opportunities.
And lastly, the K stands for know-how. So our experience, both as clients, as practitioners, as business owners ourselves, all of these things come as family men ourselves. All these things come into who we are as our experience. Our education is also very strong. And again, we are really excited to talk to you guys a little bit more, not so much about our firm, but about the industry as a whole and pensions. Here we go. So it's important to kind of understand what vantage point someone is coming from when they're talking to you as an expert in the investments and advising space. So we are what's called a registered investment advisor. This was established in 1940 as the Investment Advisors Act. Basically, RIAs, they act in the best interest of their clients. They act as a fiduciary to their client. They utilize custodians. So your money is not held with them. It's held separately by a custodian. Ours happens to be Charles Schwab. There are others. That's to keep it safe, to keep it away from the Bernie Madoffs of the world. And the RIAs employ investment advisors, and that's who we are.
I would just add to that. We are not meant to work with every person out there, and everybody's not meant to work with us. However, I think an important starting point in any individual's path towards identifying if an advisor is right for them, and then if an advisor is right, which advisor to work with. And we certainly feel very strongly that working with an RIA is an absolute must.
Let's get right into it. So the Ford General Retirement Plan has some key dates associated with it, and we're not going to bore you with all the gory details here, but basically at the end of World War II, towards the end of World War II, Ford created their retirement plan, and then they updated that in 1950. Fast forward many years, January 1, 2004, the plan closed to new participants. What does this mean? This means that the pension portion of the retirement plan was no longer being offered to employees who came on board at Ford after 2004. So then in the subsequent years, there's been some additional changes. One of the things of note here was in 2012, those who were part of the pension plan were now eligible for a lump sum. So that leads us to where we're going to be talking a lot today. There are two choices within the Ford pension plan. When you retire, you have the option of taking monthly pay. You can include your spouse in that as well as a beneficiary. If you do that, your monthly income will actually be reduced. We'll talk about that. Or you have the option to go into a lump sum. We will talk a lot about that because that's a choice that we think is a good fit for a lot of people, but not everybody. So what are some of the attributes of the monthly pay? First of all, it's consistent pay for life. So this is sort of like Social Security, Jim, but it's not, right? So one of the differences between this and Social Security is that it does not have any inflation adjustment, right?
That's correct.
So another thing that we have here is spouses can be included. Again, they are the only one that can be included. You cannot include children. So in other words, the monthly pay is going to last for the period of your life and or your spouse's life, but it will not extend to any additional heirs.
If I could interject one important point here, I think that starting my career in 2011, to Jeremy's point of the key dates in 2012 was when the lump sum started. I've been working on these basically since I started in the business, and what I've found from working with clients at the different firms I've worked at is that there were some that were not aware of the integration of the pension plan with Social Security. And what that means is if you select the monthly pay to receive your pension benefit, whether you are aware of it or not, you become eligible to receive Social Security at 62 years of age. And at that point, Ford reduces the monthly amount they pay to you. So when I first started working in the industry, I had clients that were not aware that the benefit that they were receiving before they turned age 62 was going to drop. And they were hit with this reality when all of a sudden the amount that went into their checking account on a monthly basis was reduced, and it was reduced by a substantial amount. And that's basically because Ford is saying, hey, listen, you're now eligible to receive Social Security. Whether you actually claim it or not is irrelevant. The fact is, the term they use is Social Security integration, and the fact that the plan integrates with Social Security, there will be a reduction in the monthly payment the day that you turn 62.
It's a really good point. That's our last point here on this particular slideshow. We're going to go now to attributes of the lump sum. So the lump sum comes to you in one large payment, and then it is your money to do with almost as you please, right? I mean, and we'll talk about the logistics of how that works. People are not taking that and putting it directly into their bank account. Rather, they're transferring that over to an IRA. But the investment choices are yours. You have the benefits of income creation off of that money, as well as wealth creation for the future. So you can do both of those things at once when you have the lump sum. Your inflation risk is reduced with a lump sum because you have the opportunity to get yourself into investments, right,
Yeah.
that are going to outpace inflation. Currently, those inflation rates that we're seeing today, Jim, are really high, right? So it's a high bar for that. But typically, what has the inflation run rate been?
Well, I would just say that the inflation run rate for the last decade or so has been close to 2%. But however, we're seeing much larger numbers in the current year. But I think the important thing to think about here is, if you look back historically, what has been the best hedge for inflation? Some people think it's been gold, but the right answer actually is stocks. Stocks have been the absolute number one inflation hedge, and that's proven to be true objectively over very long periods of time. So to your point about the investment choices are yours, the ability to have some of the lump sum invested in stocks is a great hedge for inflation.
One of the big concerns that a lot of people working for Ford or other companies, it's not specific to Ford, is that if you take the monthly pay option, you have the risk associated with that employer going into bankruptcy.
Right.
And I know this is a big deal, and this has happened in the auto industry in the past. So when you have the lump sum, you no longer have that risk like you would on the monthly piece. And that, for some people, is a very large peace of mind. The other thing that we wanted to mention here is that the lump sum enables you to build that long-term wealth and perhaps give a significant inheritance to your children, your loved ones, or charities of your choice, right?
Absolutely. I think that is something I've experienced that seems to tie at the emotional heartstrings of a lot of clients of, yes, I've worked for this company for a long time. I've sacrificed a lot to give to Ford Motor Company. And at that sacrifice has been a lot of time with family and friends. And not being able to leave anything to your children from the pension benefit often is something that is less than ideal. And so the opportunity to take a lump sum buyout does enable you to create that long-term legacy within the family.
Okay, so we've talked a little bit about the attributes of both the monthly pay and the lump sum. So the question now is, what should you do? And Jim, we've talked a lot about this before. Tell me a little bit about your thoughts here.
So I think the key point I would make here is that there is no one universal decision. There's not one decision that is right for everybody. Again, when you go back to those attributes that we've reviewed in the previous slides, there are certain elements of each decision that will fit better for some than others. And again, as somebody who's been doing this since I've been in this line of work, I've seen decisions made both ways. And again, it's just making sure that when you are making this decision, that you do so in the context of a customized financial and retirement plan built for that specific individual.
So we've got a couple of pivot points here that we sort of like to go through with clients. Do you have a history of running out of money or running low on money? And really the concern here is that, if somebody's got sort of a sketchy track record, and when I say sketchy, I just mean it's not very straightforward. You're not particularly good with money, and maybe you know that, right? You don't do well with budgets. At that point, maybe the best choice for you might not be the lump sum, right?
Right.
It might be the monthly pay. However, right, if you were to do the lump sum at that point, you'd really want to get some advice. You'd really want to get a team built around you so that you can establish a strategic plan for the future.
Absolutely, I couldn't have said it better.
And do you value having control of your money? That is really a very, very personal piece to all of this, and I think this one tends to skew in the side of, if you do, then you really want to go with the lump sum. Again, this is not a hard sell by any means. These are questions that people need to ponder. Lastly, do you have children, grandchildren, or favorite charities? And this speaks a little bit more to that inheritance piece.
Yeah, inheritance and taxes, I think, are also covered in here. It's a much more nuanced and individual specific when you get into the tax rates of what you'd be paying on the lump sum versus the monthly pay, and if charities are important to you, some of the strategies that are available. But I think there is more flexibility clearly with the lump sum, right? The ability to roll it to an IRA does provide more flexibility for those that are seeking.
Which really what we're trying to do here is summarize those lump sum desires into some bite-sized pieces, more flexibility and tax control, as Jim mentioned, the reduced inflation risks associated with the lump sum, much stronger. You can get involved in equities early on and build your purchasing power protector with that plan. And then lastly, the estate. Your estate is, to some people, that's not a big deal. You know, you can't take it with you,
Right.
but some people want to have a legacy, and this is one of those areas where it potentially enables that.
Yeah, so the thing I think I see most important here, and this is self-serving as a CPA, but in the plans that we have prepared for clients, in doing the analysis of the lump sum value, the control that you receive from taking the lump sum, particularly from a tax perspective, these are, when we're talking specifically about forward clients, these are people that are looking to retire, typically late 50s, early 60s. And required minimum distributions from the IRA don't start at this point until age 72. So there's almost, there's typically at least a decade of time that we have between the day that the lump sum would be paid out to when the IRS requires money to be taken from that account. It gives us a lot of flexibility from a tax perspective, and we've seen benefits from a tax perspective that eclipse $1 million in tax savings over somebody's life expectancy, assuming that person is going to live until at least 90 years of age.
Great. So why does Ford offer a lump sum? Why do any of these companies really have this offering of a lump sum? And I think there's a little bit of concern out there, some in the conspiratorial space, that that it might be the company is doing this with nefarious reasons. In fact, we've really kind of looked into this, and it's much more nuts and bolts, much more about dollars and cents, isn't it?
Absolutely.
So at the end of the day, we've got some stats here from 2020, and what you see is that the Ford pension plan itself has a lot of liabilities on the balance sheet, and so there's oftentimes a delta between where they are in any given year and where they should be to meet up with ERISA law. And therefore, in the particular example here, Ford has to infuse almost $1 billion worth of money into the pension plan to shore it up, to make it viable for the future, right? And they're doing this. They're a fantastic company. They've been committed to this, and there's no signs that they wouldn't be committed to it at this juncture.
Correct.
That said, they would much rather get these liabilities off of their books, right?
Absolutely.
So to them, $1 million, $2 million, whatever your lump sum might be, it's not a lot of money.
Absolutely.
Not to them. It is, in fact, to the recipient, but to the company, it's not a big deal. They would much rather take this off of their balance sheet and have a known quantity of liabilities, and ultimately they'd like to erase those liabilities.
Yeah, again, we're going to talk about the important factors and how the lump sum is calculated, and life expectancy is certainly one of the important factors. So it's a balance sheet cleanup for them of getting that liability off of the balance sheet. But obviously, a company as large as Ford Motor Company has a lot of risk management being done within the organization, right? And the risk of the long-term pension that if these employees live much longer than what they are expected to is a greater risk. So it's also part of like the devil they know might be better than the devil that they know at this point.
So we're turning the conversation now to what we know about how it is that the lump sum value is established, some of the inputs to it. And so the number one input for that is what's called the discount rate. Jim, walk us through the slides here, or the images here, to kind of give the audience a feel for what's going on.
Yeah. So when I think about the lump sum value and the discount rate and the effect that the interest rates have I would equate this very much to a bond. When we talk about investments with clients, we talk about but the price of bonds are inversely related to interest rates. When interest rates rise, the price of the bonds fall. And the same holds true for the lump sum calculation. And so what this graph here shows you is we've sort of hit this inflection point of a bottoming out of the interest rates, and that there really wasn't much lower they could go. And when I think about how is this lump sum calculated, you have like your internal factors, which are internal to Ford, and then your external factors. And this external factor is the interest rates. We've seen a dramatic increase in the interest rates that are applied. They come right from an IRS table, but the interest rates as of where we stand right now in 2022, you're talking about the impact of the rise in rates. We're probably looking at somewhere between a 20 to 30% reduction in what the lump sum value would be if you don't claim that in 2022. And if you wait till plan year 2023, that's again where you're going to see somewhere between a 20 to 30% reduction in the value of your lump sum.
And we've got a little bit more information on that as we follow through with some of the additional slides here. The second biggest impact on it, and Jim, you mentioned this before, is the actuarial life mortality tables here. These are from the Social Security Administration. They basically show what one's lifespan is expected to be. Yep. Doesn't mean it actually is, but this is a factor in building out how much the pension value is worth for any individual, depending on what age they are at the time at which they're retiring, right?
Absolutely. Yeah, mortality it's often difficult to talk about with many individuals, but this table is very straightforward, and the joke has been in many facets of retirement planning. If you could tell me the day you're going to pass away, we can tell you the right answer. So it certainly is a very important factor in consideration in your personal situation as it relates to choosing lump sum versus a monthly payment.
So we've done the homework and we've sort of cracked the code here of the lump sum. We've taken all the inputs that Ford Motor Company utilizes, and we've built out our own calculations to mimic what it is like for any individual who might be looking at a retirement in a particular year. So what's the purpose of this? Well, I think the purpose of it is that we can kind of accurately design an understanding for clients as to how much their lump sum is going to be in this particular given year. Right. And also we can start to compare that to, okay, what would that have been like last year, if that's important for you to understand? But probably more important, what would that be like next year if you were to retire, and what's the differential there?
Yeah, no, I think that's spot on. I think we always talk, here at OnTrack that, to build a really fundamentally sound plan, you need to know where you're at. You also need to know where you've been and try to best predict where we're going in the future. And again, when we're seeing the interest rate moves with the math that we're applying to that, we're able to get out in front of a projection for Ford employees as far as, okay, what does this change in interest rates mean for me? Even though I can't see that on my Ford benefits yet, can you give me an idea of what it looks like? And that's where we're really able to provide a lot of value.
And if you're one of those Ford employees who's looking to do this, obviously we're happy to help you out with going through this equation with you. And then your next steps would be to talk to the folks at Ford Benefits, and then they can give you a more accurate understanding. That looks a little like this, doesn't it? So this is sort of our anatomy of some of that paperwork. It's a lot of paperwork that they'll put in front of you. There's a lot of things to skim through. This particular section is the pension plan choice form, and it's the option for the lump sum. So they're going to give you what your lump sum would look like if you were to retire in this particular year, and of course that's subject to change. They're telling you very much so that is subject to change. How often do these things change? What is the chronology of how this works with the Ford plan?
Yeah, that's a great point. Ford's lump sum calculation changes for the following plan year. So right now is actually when the change is going to be taking place. When the August IRS interest rate numbers are printed, so it'll be about mid-September that Ford will adjust the calculation that you would see in My Ford Benefits for the 2023 plan year. So the numbers that you have in your projections right now are still good for the 2022 year, but you're going to see in the next couple of weeks an update. So it's the end of August rates are what apply to the calculation of lump sum, and it's done so it adjusts on an annual basis.
So if somebody is looking to retire from Ford and they're really interested in the lump sum piece, how is that clock ticking and what does that look like?
Yeah, so that basically means you have to be retired from Ford Motor Company by the end of this calendar year, which based on our understanding from how the paperwork unfolds, you pretty much need to be retired by November of 2022 to take advantage of the interest rates that are in place for the 2022 plan year.
So the clock is ticking. And the reason why this is particularly impactful for everyone right now is because, as you mentioned before, we're talking 25, 30% moves on the lump sum valuations year over year, right?
Yeah, absolutely.
We haven't seen anything like this in certainly in recent history, probably ever,
Right.
for some of these pensions, right? Because the massive moves in the interest rates. So the clock is ticking. It's something that we would urge everybody to really kind of think about their futures and how this is going to affect them. And one thing I do want to point out here too is that within the paperwork, oftentimes people are sometimes unknowingly putting after-tax dollars into the pension, right? And that money will be returned to you in an after-tax form. Remember,
Correct.
The lump sum, eventually taxes are going to have to be paid on those funds when they're distributed. However, if it's after-tax dollars, you'll get that back right away in a check.
That's exactly right. Yeah, which is, and it's always been one of these sort of like wonderful surprises for the clients that we've worked with in this process of when they start to bring us the paperwork, they weren't even aware that 20 plus years ago that they put after tax money into this plan, or if they did, they forgot about it, and now they're surprised to see that, hey, we've got this nice little extra bonus check that's going to be paid to us tax-free in cash right when we retire, which is a nice buffer for their cash needs.
There's a lot of things you can do with that. Obviously, you can spend it.
Right.
You can use it as an opportunity to make more Roth conversions.
Right.
There's a lot of different things. So it's a great point. So we've talked a lot about the different attributes, the lump sum. Now we really want to talk about kind of how does this all knit together, right? And so the way we see this is through a process. You're doing that lump sum analysis. Then you really got to start looking at your retirement plan analysis. And that starts with sort of a cash flow analysis in retirement, doesn't it?
Absolutely, yeah. When I look at this slide, the thing that jumps out at me, especially for a firm like OnTrack, is we build a comprehensive plan for all of our clients, right? And so you need to build and it's done on a cash flow basis, and we need to look at how do all of these individual factors, you look at lump sum, retirement, the taxes, the investment, and these things, how do they all fit in together under one overarching plan? Because these questions cannot be solved individually in individual vacuums. They need to be done integrated with each other, because they absolutely have, one box here absolutely has a massive impact on the next box, and so on and so forth throughout the planning process. So again, yeah, you need to sit down and work with, again, if it's you're working with a financial planner, you need to work through a comprehensive plan to really understand how do these pieces all fit together.
And that really speaks to the centerpiece here, the tax savings analysis.
Yeah.
That's huge. I mentioned before that I had 20 years as a client. I worked with a brokerage firm at one point. I started working with Jim later in my investing career. And one of the things I noticed there was that oftentimes when it came to tax questions, most of the time when I was dealing with a broker, it was, well, you're going to have to go talk to your accountant about that. And one of the nice things about when you're dealing with a person who is a CPA as well is they get the whole picture, right? They can see the whole thing. So this tax analysis piece is really, really big, because we think this is where you can outperform.
Yeah. Yeah, no, so it's funny you say that. A lot of times, if you were to be working with one of those brokerage firms, there's nothing inherently wrong with them. However, if you ask them a tax question, they literally cannot answer it, or at least they can't document that they're answering that in the form of an email. They would be rushed into a compliance meeting that would not be very fun for them. They literally tell you, I can't answer that. You have to go consult your tax advisor. And that's one of the beauties of working with a firm like OnTrack, where we have, to the point you brought up before with our profiles, certified financial planner, certified public accountant, masters in financial planning. We have the know-how, the K and track, we have the know-how to integrate this and answer all these questions together in one truly comprehensive plan.
The next step in here is the investment portfolio design. This is where we build out allocations. This is a really critical portion of figuring out, how much money do I need in fixed income so I can have ready and safe access to money in the near term. But I'm also at the same time building a nest egg for 10, 20, 30 years down the road in my retirement or for my inheritance, right?
Absolutely, yeah. I think the T, R, and C, the name track really speak to the investment portfolio, the tax adjusted, risk adjusted, and cost adjusted returns, and making sure that you're optimizing those in the portfolio, and understand how that integrates across all the different account types as well.
And in a holistic plan, you always have to talk about estate planning too, right?
Right.
So this is a thing that a lot of folks maybe don't like to talk about, or maybe they just don't know much about it. But there's some pedestrian, ordinary things that you have to do with estate planning. And then there are some extraordinary things that you can get into as well. If you're in one of these scenarios where you might be hit with estate taxes, then there are a lot of planning options for you, and there's a lot of things that got to be done.
Yeah, I mean, the one constant in this area is change, right? I mean, this number, what I've seen in the time that I've been in the industry, is this number has changed greatly. I mean, it literally, what you went from a time in like the 1990s where the lifetime exclusion, so the amount that you were worth, if it exceeded $600,000, you were hit with estate income taxes, and that was penalty. So there was a lot of planning done around that, and then that number has, it's slowly crept up, and then has taken, some substantial jumps forward, so that there are very few people that are subject to the estate income tax at this point. However, I think most prognosticators would predict that we're going to see a bit of a reversal and a reversion to the mean when it comes to that. So it's very likely that more American citizens are going to be subject to estate planning needs because of the value of their estate.
Change is the name of the game for sure. So the million-dollar question here, and it might be a multi-million-dollar question for some folks, is does it make sense to do this alone? And we wanted to present some data because we don't want to just give opinion, be data-driven here. So there's a quantitative analysis that's done by an outfit called Dalbar. And Dalbar looks at the average investor returns compared to, say, market benchmarks. Mm-hmm. And here's an example. Here's their latest data set from 2021. And in this particular year, the average investor had an 18% return over the course of the year. That sounds fantastic. And in fact, nobody can argue that in a normal year, that's pretty darn good, right?
Agreed.
However, here's the deal. The S&P 500 rose by nearly 29%.
Yeah.
So there's a 10 plus percentage point gap. And that gap is where people oftentimes don't even realize it's there. Right. And if you're having that issue, chances are you probably haven't gotten great advice, or you're probably doing it yourself, right?
Absolutely, yeah. So this is a study that I've been looking at for years and years, and I do find it to be very interesting. I look forward to its release every year. But I think what we find very frequently is in a year like 2021, where the market did as well, the U.S. stock market did as well as it did, many investors that are doing it themselves can be lulled to sleep by looking at their monthly statements and saying, oh, look, yes, I got, my portfolio is up. I must be very good at this. And it isn't until they face headwinds like what we are sort of starting to see in 2022 that there is more of a reality that, maybe I'm not as good as I thought. But I think one of the key thing that I see here is the investment return, the investment rate of return is more critical at this. So the people that we're talking to on this video, the investment rate of return has never been more critical to them at any point in their life. They've been saving this nest egg, these assets. They've been saving them so they can retire and start to draw, an income off of that asset base. And the investment rate of return now is more important than it has ever been before, and it only continues to become more important throughout their retirement. And most people also think that it's the bad markets that they can't, that they can't afford to live through, and that's actually, this academic studies have proven that not to be true. The fact of the matter is we have longer summers than winters, and the actual math shows you can't afford to not be participating in the up markets. And in the analysis here, with a 10% gap, it's not that they're not participating, but they're not maximizing, and that S&P 500 return just represents the average, right, of 500 companies. So you're not even talking about above average. This is just getting to the average.
Absolutely. It's a great point. So we want to look at this from a longer time horizon. And so here is that data set as well. And what you see is, it's not necessarily as dramatic as the 10% gap that was in 2021, but guess what? It's still a big gap. Using the 10-year mark as an example, the average equity fund investor has over that period of time realized 13.44% annual, right? And you compare that to, just let's take the benchmark of S&P 500, the top 500 large cap companies in America. That's at 16.5. That is a 3% difference, right? Doesn't sound huge, but that's year in, year out, right? So these are big difference makers when you start applying the math.
Absolutely. The thing that strikes me most from this, so you're pointing out that the 10-year number, is that same percent. So most times when you look at outperformance, the longer the duration of the analysis, the narrower that gap becomes. Mm-hmm. However, look at the 30-year here. You've got 7.13% for the average equity investor over 30 years. And the same analysis that uses at 10 years, we'll use the S&P 500. You're at 10.65. You're talking about that number actually got larger. It's now a 3.5% difference.
Right.
And 3.5% over 30 years is when you apply 3.5% per year to a large number like what we'd expect to see from a lump sum buyout, that becomes an astronomical difference in ending portfolio value when you compare somebody that's getting 7.13 to somebody that's getting 10.65 per year.
Yep. The numbers extrapolate real fast. So from a qualitative perspective, right, we try to look at this performance of the average investor, and we kind of try to create two different buckets. There's a team approach, there's a do-it-yourself approach. Let's talk about the do-it-yourself approach for a moment. There's some self-satisfaction with being able to take on a challenge, do it yourself, and manage it yourself. There's also no fees associated with that, right? So it is ultimately, in terms of actual dollars spent to get to where you want to go, it's perhaps the least expensive, but that might be a little bit of a misnomer, right? You might not have the same results. In fact, the research shows you do not. The team-based approach is one where somebody's going to build a team of experts. They're going to get the coaching associated with that, and they're going to get, in short order, better outcomes.
Right. Yeah. I mean, there's plenty of academic studies out there that Vanguard is a well-known fund company that they produce a study each year that's called the Advisor Alpha, right? So it's like that's the advisor's outperformance, and they've come up with a number about 3% per year in outperformance from working with a high quality advisor. I understand that the merits of the do-it-yourself approach are there, but the fees associated with working with a professional team in particular, I think working with a team is important, but the outcomes there, as you mentioned, are typically superior.
And the last thing I just want to mention, to go back to the coaching piece. So a lot of the market mentality comes down to a psychological approach, right? If left to one's own devices, they typically get a little skittish around certain events. If if you have major drawdowns in the market, like we're experiencing right now, there are some people who are getting out of the market. And that can be very damning to their long-term portfolio. Because when do you get back in, right? How do you miss those upsides that you were talking about earlier? Yeah. So there is a psychological coaching that comes alongside a team approach. In a good case, they're gonna lead you down the right pathways and keep you there.
Absolutely. Circles back to the importance of building that comprehensive plan and the investment allocation, of building an allocation that you can live through.
So who should manage your money? Okay, we're really, we're trying to give a very high level discussion around this. But Jim, just walk us through this real quick. We've got a couple of gears here that we find to be fundamental.
Yeah, again, so I sort of mentioned before in the RIA slide that, we think, the most important decision you make in selecting an advisor would be choosing an independent advisor that is not beholden to anybody else but the client's best interest. So as a registered investment advisor, OnTrack, that is, literally who we are and what we do. We are paid by nobody else other than our clients. They are paying for our advice, and we are incentivized to maximize their outcomes. And then when you take, so we're structured in a way that we think is fundamentally sound, but then you add in, we also have the professional training as certified financial planners that is the gold star of the industry from a financial plan perspective. It has the most stringent ethical requirements and painfully so a substantial amount of continuing education requirements. So we have to continue staying on top of as we talk about these changes, and the only thing constant in this world is change. We have to stay on top of all that through the continuing education. So when you take those and then you blend it with the other discipline of having a master's degree and a CPA here, we really do have that expertise to continue to drive long-term successful plans for clients.
And I think what's important to add into the mix is you're looking for expertise for you, and it's also really important to say the right fit for you, right? OnTrack might be the right fit for some people, might not be the right fit for other people. But there are folks out there who can help you, and you need to look for the basics, and then you also need to look for that level of expertise. Do they understand your situation? Do they understand? So if you're talking about pensions like we are today, do they understand that program and how it works? These are the things you guys want to look for in order to figure out who it is that should manage your money long term. So we're running up against the end of our time here today. We did want to let everybody know that you can schedule a complimentary financial review with us. You can go to our website, ontrackplans.com. From there, you can click on those orange tabs, schedule a meeting. Gives you access to Jim's calendar, my calendar. Choose a time that works for you. It's completely no pressure, and it's a good opportunity to talk about your situation a little bit. Or feel free to call us or email us. That's all good.
And I just highlight that is complimentary. The initial consultation is complimentary. The initial discovery phase is send us an email, give us a call. We're happy to have the initial conversation and see if we might be the right fit.
Everybody, thanks for sticking with us here today. We hope that you've enjoyed this. We do have our last slide here, our disclosures. So if you haven't taken a nap today, go ahead and read through that and enjoy. But thank you so much for being with us.